Wall Street initially mocked what would become one of the most successful investment products in history. Critics called it un-American and a guarantee of mediocrity. They circulated materials mocking its creator, nicknamed Bogle's folly. Today, this product manages trillions of dollars and has quietly made more ordinary people wealthy than almost any other strategy ever devised. That product was the first retail index fund, introduced in 1976 by Vanguard. And over time, it became clear that the joke was on Wall Street, as index funds consistently outperformed most actively managed mutual funds after accounting for fees. So today, we are going to pull apart one of the strangest truths in all of finance. The boring, cheap, do-nothing strategy that has beaten most highly paid professionals over long periods of time. Not sometimes. Most of the time over decades. And I want you to understand exactly why, because once you see the mechanics, you cannot unsee them. This is not a pitch. I am not telling you to buy anything. This is the history and the math of one idea. Let's get into it. Start with a simple question. What is a stock market index? An index is simply a list. The S&P 500 is a collection of roughly 500 of the largest companies in the United States, combined into one measurable unit. When you hear that the market went up or down today, you are usually hearing about an index. It acts as a scoreboard for the overall performance of these stocks. However, it is not something you can buy directly. Rather, it serves as a measurement tool, much like a thermometer reading for a significant portion of the economy. Now for most of financial history, if you wanted to invest in stocks, you had two problems. First, buying lots of individual companies was expensive and complicated due to high transaction costs and limited access to information. Second, everyone assumed the way to make money was to pick the right companies. Find the winners, avoid the losers, and beat the market average. That is what investing meant. That is what you paid a professional portfolio manager to do. Enter the index fund. The idea is straightforward. Instead of trying to pick which specific companies will outperform, you simply purchase a small portion of all companies in an index like the S&P 500. Each company's representation in the fund corresponds to its market value. You are not betting on Apple over Microsoft or one bank over another. You own shares of every company included in the index proportionally. Essentially, you buy the entire market snapshot. Think about what that means. By investing in an index fund, you are essentially replicating the performance of the overall market rather than attempting to outperform it. You are aligning your returns with the average performance of all companies within the index, minus a very small management fee, and you stop trying to be clever by picking individual stocks or timing the market. To a lot of people in 1976, that sounded like surrender. Why would you settle for average? Average is often perceived as mediocre or losing. But here is the first counterintuitive truth. In investing, average performance over the long run can be quite impressive. Over many decades, the stock market has historically delivered average annual returns of about 10%, after adjusting for inflation, which translates to an above-average outcome for most investors. Because the average you are settling for is the average of the entire market, and consistently beating that average return is one of the hardest things any professional in finance ever tries to do. Let me explain how index funds work and why they often outperform most individual investors. His name was Jack Bogle. In 1975, he founded Vanguard, and in 1976 he launched the first index fund available to individual investors. His pitch was radical. He said, in effect, stop paying experts to guess which stocks will outperform. Stop paying high fees for the fantasy that someone can reliably beat the market. Just own a piece of the entire stock market through an index fund, keep your costs as low as possible, and let time do the work. Wall Street thought this was ridiculous. Actively managed funds, where a manager and a team of analysts pick stocks and trade in and out, were the cornerstone of the business. That is where the fees lived. That is where the prestige lived. A fund that just bought everything and did nothing. That charged almost nothing. It threatened the whole model. So they mocked it, calling it Bogle's folly. Bogle's first index fund, the First Index Investment Trust, aimed to raise as much as $100 million at launch, but only managed to attract about $12 million initially. Despite this modest start, the fund laid the groundwork for what would become a revolutionary investment approach. And yet Bogle understood something his critics often overlooked. He understood arithmetic. Here is the argument, and it is so clean it is almost impossible to escape. Think about all the money invested in the stock market as one giant pool. Some of it is managed passively, just tracking the index. Some of it is managed actively, trying to beat the index. Now the market return is the market return. It is a fixed pie. Before costs, the average dollar of active management and passive investment must earn roughly the same as the market itself, because together they basically are the market. That is not opinions. That is definitional. But here is the twist: active management costs a lot more. All those analysts, all that trading, and all those fees eat into returns significantly. So after you subtract costs, the average actively managed dollar must underperform the average passively managed dollar. This is not a maybe. In the aggregate, it is a mathematical certainty. The higher your costs, the greater the hurdle you need to overcome just to break even with the passive approach. This argument was laid out cleanly by Nobel Prize-winning economist William Sharpe in his piece sometimes called The Arithmetic of Active Management. It is not a theory that might be wrong, it's basic subtraction. Now you might say, fine, on average, active funds lose to passive index funds after fees, but I will just pick the top-performing active managers. However, it's important to note that consistently identifying and selecting these winning active managers is extremely difficult due to their scarcity and unpredictable performance over time. Beautiful idea. Let's test it against the evidence. There is a long-running study called SPIVA, S&P indices versus active. Each year, S&P Dow Jones Indices publishes data comparing how professional active fund managers perform against relevant market indices. This comparison is based on actual results, not opinions or marketing claims. And the results are brutal, consistently, decade after decade. Over a single year, plenty of active managers beat their benchmark. Often roughly half, give or take, which is about what you would expect from chance. But stretch the time horizon out and the picture collapses. Over 15 and 20-year periods, the large majority of active U.S. stock fund managers underperform their benchmark index. In many recent reports, over horizons of 15 years or more, we are talking about something on the order of 80 to 90% of professional funds failing to beat the simple index. Over longer periods, such as 20 years, it has run around 80 to 90% in the headline U.S. large cap category. These are people who do this full-time, who have Bloomberg terminals and armies of analysts and Ivy League degrees. And yet, the large majority still underperform a fund that just buys everything and sits there. Read that again. Over the long run, most professional investors underperform compared to simply holding an index fund, which is often referred to as beating nothing, since it represents the overall market performance. How is that possible? There are three main reasons, and you likely already know two of them. Reason one is that costs drag returns down. Higher fees reduce the net return an investor earns, which can significantly impact long-term growth. This is why index funds, which typically have lower expense ratios and management fees compared to actively managed mutual funds, often outperform most investors over time. Lower costs allow more of the market's returns to accrue to the fund's shareholders, enhancing overall performance. Reason two is that markets are fiercely competitive. The price of a stock at any moment already reflects the combined expectations of millions of smart, motivated, well-informed people. To beat the market, you do not just have to be informed and skilled. You must be more accurate than the collective wisdom of all other participants consistently over time. This is not impossible for short periods, but is extraordinarily difficult to achieve consistently over decades. Reason three is survivorship bias, and this one is sneaky. Funds that perform poorly often get quietly shut down or merged into other funds. So when you look at the list of funds available today, you are seeing only the survivors. This makes the average active funds track record appear better than it actually was historically, because the poor performers have been eliminated from view. The true picture is even worse than what the surviving data suggest. Now let's talk about the single most important concept in this entire subject, cost. Because cost can be a major factor in investment performance, and many investors don't realize its impact until later. When you own an index fund, you pay something called an expense ratio. It is an annual fee expressed as a percentage of your money. A typical low-cost index fund might charge around 0.03% to 0.2% per year. Let me put that in real money. On $10,000 invested, a 0.04% fee amounts to about $4 a year. $4. Meanwhile, many actively managed funds charge 1% or more per year. On the same $10,000 investment, 1% is $100 a year. $100 versus $10. While the difference might seem minor at first glance, it can have significant implications over time due to the power of compounding and investment returns. Here is where it gets vicious, and this is the part the industry does not highlight prominently. That fee does not just cost you the amount of the fee, it costs you all the growth that money would have earned if left invested, compounding over time for as long as you invest. This is the silent tax. You never see a bill, but the fees are skimmed off quietly before you ever look at your balance. Let me give you a Klein illustration. Imagine two people who both invest and both earn the same market return before fees over 30 years, say around 7% a year, which is a reasonable long-term average for a broad stock market after inflation. Though of course the real world is far bumpier than any smooth number suggests, and no return is guaranteed. One pays 0.05% in annual fees. The other pays 1% in annual fees. That gap is 0.95 percentage points. Over 30 years, on the same starting amount of money, the low-cost investor can end up with significantly more wealth, often around 25% or even higher, purely because less was skimmed off along the way. Same market. Same returns before fees. The only difference is what got quietly removed each year through compounding costs. Bogle had a phrase for this that I love: in investing you get what you do not pay for. Read that one twice too. In most of life you pay more to get more. But in investing, the less you hand over in fees, the more you tend to keep. The relationship is often inverted. High costs do not buy you high performance. On average, high costs result in lower performance because the cost is a guaranteed drag, and outperformance is not guaranteed at all. Now at this point, the smart skeptic might push back. Fine, on average active management underperforms due to fees and transaction costs. But what about legendary investors who have beaten the market? And yes, there are genuinely brilliant investors who have beaten the market over long periods. Nobody is claiming it is impossible. However, the claim is narrower and more useful than that. The claim is that it is rare, difficult to identify in advance, and paying up for the attempt usually costs you more than what you gain. Knowing that a few people won the lottery does not make buying lottery tickets a viable strategy. The question is never whether anyone can beat the market, but rather whether you can reliably pick, ahead of time, which expensive fund will outperform the market over the next 20 years. And the evidence suggests that this is close to a coin flip, and you are paying a premium for the privilege of flipping it. Which brings us to one of the greatest public demonstrations of this idea, known as the Berkshire Hathaway Missourian Challenge. In 2007, billionaire investor Warren Buffett made a 10-year bet with protege Ted Sades that an S&P 500 index fund would outperform a portfolio of hedge funds over that period. Warren Buffett, one of the most successful active investors in history, does not believe most people should try to replicate his investment success. In 2007, he issued a public challenge by betting that a simple, low-cost index fund tracking the S&P 500 would outperform a hand-picked basket of hedge funds over a 10-year period. Hedge funds are known for being managed by some of the highest-paid and most sophisticated money managers on earth, who often charge significant fees, typically around 2% of assets under management annually plus an additional 20% performance fee. In 2007, investor Ted Sades took up Warren Buffett's challenge through his firm, Protégé Partners. Sade selected 5 funds of hedge funds, portfolios managed by experts who chose what they deemed to be the best individual hedge funds. Meanwhile, Buffett placed his bet on a low-cost S&P 500 index fund. The winner would donate their gains to charity over a 10-year period ending in 2017. The bet ran from the start of 2008 through the end of 2017. And 2008 was indeed a catastrophe, with a historic crash that year. So the index took a brutal beating early. But over the full 10 years, it was not close. The simple S&P 500 index fund compounded at an average annual rate of about 9.6%, ending up more than doubling in value over the decade, while the basket of hedge funds gained only around 2% per year on average. This is a small fraction of the index fund's return. The professionals, with all their tools and all their fees, got beaten by a product designed to do nothing but track the market at rock-bottom cost. Warren Buffett's takeaway is clear: fees are the enemy. High expenses eat into returns, leaving investors with less than they could have earned otherwise. Managers may perform well personally, but their clients often do not due to these costs. So by now you might be thinking this is a magic bullet. It isn't. And I promised you honesty, so let's discuss the trade-offs. Because a strategy without acknowledged downsides is a sales pitch, not an educational tool. Trade-off number 1. Index funds fall during market crashes just like the overall market does. When you own an index fund that tracks a broad market, such as the S&P 500, you experience both its downturns and upturns. For example, during the financial crisis of 2008, the S&P 500 fell about 37% from its peak to its trough. Similarly, in early 2020, when the pandemic struck, the same index dropped approximately 34% over a few weeks. An index fund does not provide protection against these declines because it mirrors the market's performance. If you cannot tolerate seeing your investment drop by this amount and remain invested through the downturns, the strategy may not be suitable for you due to its reliance on long-term stability and patience. The mathematics of compound returns only benefit those who stay invested over time. Trade-off number 2, and this one is philosophical. An index fund will never outperform the market by more than its fees. However, it can match the market's returns over time after accounting for those fees. By design, an index fund aims to replicate a specific market benchmark, so you will always earn slightly less than the return of the pure index due to management expenses. You will also miss out on the thrilling story about the stock that went up 10 times because index funds do not pick individual stocks, but rather hold a diversified portfolio mirroring the index composition. There is no glory here. No cocktail party braggings. You are deliberately trading the tiny chance of spectacular outperformance for the higher probability of beating most active investors who attempted to achieve such gains through stock picking. For a lot of people, this trade-off is fantastic. For some, it feels unbearably boring. Boring is the price of admission. Trade-off number 3. Not every index is the same, and the term diversified can be misleading. A fund tracking 500 large American companies, like the S&P 500, is concentrated in one country and at various times heavily weighted toward a few dominant firms. Owning an index provides diversification within that specific market segment, but does not ensure broader global diversification. The label diversified should not be taken as an assurance of understanding what the fund actually holds. And a broader honest point, the fact that this approach has worked well historically is not a guarantee of future success. Past performance genuinely does not predict future results. That sentence is a legal disclaimer for a reason. It is accurate. History provides evidence but does not ensure future outcomes. So let's step back and look at what this story is really about, because it goes beyond just funds and fees. It is a lesson about the seduction of complexity. We are wired to believe that hard problems demand complicated solutions, that effort and intelligence should be rewarded, and that the person doing something sophisticated must be beating the person doing something simple. In many areas of life, this instinct serves you well. However, in investing over long periods, it often leads you astray. The complicated, high-effort, high-cost approach frequently loses to the simple, low-cost, patient one. Not because effort is bad, but because in a hyper-competitive market where everyone is smart, the edge that remains after intense competition has eroded most of it away is very small, and the costs of pursuing it are certain. It is also a lesson about who is talking and why. The financial industry broadly does not make much money selling you something cheap and simple that you buy once and hold for decades. It makes money on activity, complexity, fees, and the constant implied promise that with the right expert and product, you can beat the average. This promise is intoxicating but, for most people most of the time, not supported by long-term data. When someone is paid based on your belief in their expertise, be extra careful before believing it. Jack Bogle's genuine radicalism was not really about the fund itself. It was that he built a company structured to charge investors as little as possible and spent his life telling ordinary people that expensive financial advice often works against them on average. And here is maybe the deepest point of all. This strategy is powerful precisely because it removes you from the equation. The biggest enemy of most investors is not the market, it is their own behavior. Buying when everyone is euphoric and selling in a panic when everyone is terrified, jumping from hot fund to hot fund, chasing last year's winner, these behaviors often lead to suboptimal returns. A simple, low-cost, buy-the-whole-market-and-hold approach works largely because it gives you less to tinker with, fewer decisions to get wrong, and fewer chances to outsmart yourself. Simplicity is not just cheaper, it is behaviorally safer. It protects you from the most dangerous person in the whole story, you on a bad day. John Bogle passed away in 2019. By then, what was once mocked as a revolutionary idea had become the default investment method for millions of individuals, with index funds collectively holding trillions of dollars. Warren Buffett, who has spent his career outperforming the market, has publicly stated that he left instructions for his own family's wealth management to favor a low-cost S&P 500 index fund. The greatest stock picker, alive advocating for a simple approach for those he cares about should highlight how challenging it is even for the most skilled investors to consistently beat the market. None of this means index funds are right for you, or right for any particular goal, or the only sensible thing in the world. It means understanding their history is fascinating, the arithmetic behind them is stubbornly consistent, and the core insight that costs compound silently can be applied far beyond investing. The simplicity and long-term focus of index funds often lead to better performance than more complex investment strategies over time, as higher fees and trading costs can significantly erode returns. Complexity in finance is frequently a cost disguised as a benefit. And the straightforward, patient approach taken by index funds has an infuriating habit of quietly outperforming those who were convinced they were too smart to need such simplicity. Those who dismissed Bogle's vision were not necessarily wrong, they were simply confident in their beliefs. However, in markets, such unwavering certainty can be costly. Quick reminder, this is financial education and history, not financial advice. I am not telling you to buy or sell anything. Please do your own research and consult with a licensed professional regarding your financial situation. This has been the Money Files.